Hello, ladies and gentlemen, and welcome back. In today's video, we talk about the VIX. And why? Because this is the most important chart for stock market, crypto market, and commodities market traders to be looking at right now. Since the VIX has moved down to 20, we've usually seen turning points, inflection points in the market. At the same time, we just saw the FOMC meeting minutes, and they said, look, we're not going to do 75 basis points anymore. Maybe we'll start to do 50 or even 25. We're reaching what we call the Fed terminal point. We also need to discuss in today's video whether if the Fed does start cutting rates in 2023, if that means that the bottom is in and that everything's hunky-dory. Well, I think you'll be surprised with the results. Let's take a look at them right now together. See you soon. Well, welcome back everyone to the Daily Show. We've got a great show today because we're discussing the Fed meeting minutes, the macro data, lead indicators, and of course the key levels that we should be watching right now. So what did the Fed minutes show us about, well, what the Fed thinks about the economy? Well, it showed a substantial majority now support a slowing pace of the rate hikes. So no more 75 basis points. This is probably a pretty good thing. We're moving towards 50 basis points expectation now for December and 25 basis point mostly hikes throughout 2023. So it could be meaning that we're getting close to what we call the terminal rate. The terminal rate is expected to be around 5% for 2023. And it kind of points towards maybe a recession, at least based on the indicators we'll look at later on today's video, being around March and April of 2023. That's where the terminal rate is met. So if the Fed does pivot, which everyone's now talking about, does that even mean that the markets have found their bottom? Well, let's take a look at some of the stats around that. The first one here is Fed's historical rate cuts before each market bottom. Remember, rate hikes do damage to the economy. We'll see that with copper and the copper price a little bit later in today's show. The economy is starting to reel from these very quick rate hikes. To support that, the Fed will usually cut to try to support economic growth. And of course, hopefully they'll get inflation under control. Now, the most notable time that we have similarities with was the 70s into the early 80s. You can see here the rate hikes, the Volcker moments, the insanity that ensued. But actually, the market bottom happened after the cuts began the second time. Similarly, here we had rate hikes, a cut, and then we got the market bottom afterwards. Also in 2000, 2001, also, of course, in the GFC period. So historically, we know, of course, rate cuts don't necessarily mean market bottoms. In Fed pivot doesn't necessarily mean a great time for markets moving ahead. But we do have some other very interesting stats. 2-year yields tend to peak around 1 to 1.5 months before the end of a Fed rate hiking cycle. We have seen the current period of 2-year yields peaking, so we should be relatively close. We'll talk about that more soon. And we also know that, of course, if we think about the Fed pivots, whether recessions have come afterwards or before. So it tends to be that the Fed will pivot and then we'll get the recession afterwards. Now, as you guys know, recession, the word is a bit overrated. By the time the word becomes the truth, that is maybe in 2023, March, April, the expectation at this point, what will usually be happening is the markets have already dumped a considerable portion, and sometimes they're already coming into recovery. So this is something that we need to keep in mind. Yes, okay, when the Fed pivots, it doesn't necessarily mean that it's all good for the markets, but we also know the recession usually comes straight after that or around that period. It's based on the stats. It's based on what they're seeing. Remember, they're a data-driven organization at this point. What about headline inflation? Well, the expectations are that headline inflation will drop similar in line with some of these. And this is just the expectation. But overall, most of the market is now seeing this idea that if we keep the rates at a high level for most of 2023, that maybe inflation will be dampened. And of course, what that will mean is demand destruction is well in place. It's going to put pressure on, guess what? Yes, it's going to be valuations in companies because companies will be suffering due to these extended high rates. We don't even know what that's going to look at, but I expect the next 6 months to be all about actually now, well, wait a second, these companies aren't earning what we expected. Let's crush their valuations. That could be a very real discussion moving into 2023 if we don't get the soft landing perfect scenario. What about yield curve steepening? As many of you will know, yield curves are a big discussion over the last year, and US 2-year, 10-year yield curve inversions and recessions are very, very common. Again, it's pointing towards the recession being in 2023. So let's get on to what's going on right now in the markets. So we did report last week that sometimes, or most of the time, especially leading into Thanksgiving, we do tend to see markets have a little bit of a rip. In fact, if we bought only 3-day trading days before each holiday over time, we've got a very nice return on our trade desk reports. It seems to be happening again in 2022. We know Thanksgiving does tend to do that. And some of the big bull reports right now, of course, have to do with breadth. And that is that we've seen a double bottoming kind of a breadth. We're seeing a breakout of breadth. And this is the main case for the bulls right now. We'll take a look at the 200-day moving average, the key level that's coming up. And yes, if this level does break, it could seriously mean that, maybe the bottom realistically is in. There's a very serious point of inflection coming up very soon for things like the S&P 500. What about under the hood? Well, the last 5 days have been very interesting, but let's take a look at the last 24 hours. We saw things like clean energy, gold, XLY, so of course consumer discretionary coming back heavily thanks to Tesla. It was up about 7% on the day plus, so a very strong move there. We'll take a look at that one. And then we had the rest. The 5 days tells us still a little bit of a different tale. We've got consumer staples out in front and still a lot of defensive sectors in the top 5 sectors. So this means that, again, yes, we're seeing the market drive up a little bit higher, but it's still doing so with some of the most defensive portions of the market. It's not like semiconductors is just running away with it, and consumer discretionary and other well-known recovery sectors are not the ones being bought up the most. Just a quick reminder before we get into the charts, if you haven't already followed at FX Evolution over on Twitter, consider doing so. We're posting a report free from our private community each week, so you get that through following us on Twitter. And of course, we're also posting a bunch of other very nice charts and of course, great memes as well. So if you're interested in any of those things, follow at FX Evolution on Twitter. Without further ado, though, it's time for us to get into these charts. And we've got some great charts today to discuss. The first one, straight away, the VIX. So we know that the volatility index has given us some amazing turn points this year. 35 VIX, a beautiful level for showing us that the bottoms may be in. 20 VIX, a beautiful level that's showing us that we need to be very cautious at the peaks. And I don't see why we wouldn't change this right now. Do we have enough signs going bullish? Maybe not necessarily. The breadth one's great, but we had breadth before, we had thrust before. So we do need to pay attention very closely over the next week. I think this is a serious inflection point moving forward for all markets around the world. So what's happened? Well, when we've hit 20, we've generally seen those peaking periods. When we've hit 35, we've generally seen near the lows or points of turning. For swing traders, it's been a blessing. The VIX at 20 is very interesting. Do remember as well, if we go out and push history all the way back, this would play into that idea that when we didn't have VIX above 35, any point before the GFC, suddenly something came out of nowhere, a black swan event. Is that some kind of contagion from the FTX, FTT scandal in crypto, or maybe something to do with one of the banks having a little bit of liquidity issues? We don't know yet. But if it does happen, usually and traditionally market bottoms have happened with high VIX periods. That is a 45 plus VIX. Just remember, guys, I'm not really big on trading VIX. I know a lot of you in the comment section are big on trading VIX, but I don't like the degradation of the trade. You can always see that when you load up an exchange traded fund of the VIX. But what this is great for is giving you the opportunity to mask it up with certain markets around the world and find that correlation. It's a beautiful indicator, and I always get excited about the VIX, I'm telling you that. Let's take a look at the US 2-year. What's going on in the 2-year? We've got here a potential head and shoulders for yields. If yields do drop, of course, we may have seen the peak. I've got a little alert here sitting around 4.25. I think it's important to consider this. What happened over the last 24 hours? We saw 5-year yields go down pretty heavily, 10 years also going down. This is showing us a little bit of a sickness, I think. Remember, the 2-year yield and the 10-year yield are quite different. We'll actually just load it up here. And what you can do is you can load this up yourself by just typing in US 02Y versus US 10Y, pressing enter on the charts, and then there, voila, we've made a great combo. Look at this steepening inversion yield curve. It just shows recession all over. It also shows a potential sickness that we haven't seen in the economies yet. Remember, at the moment, we're just trying to kill inflation. What about the sickness that's left over from that? Yeah, there are still problems here, and I think we need to be aware of those. Let's now take a look at the December rate hike. We got 4.14 here. By April of 2023, we expect it to be around 4.9, and you'll still see that even with the Fed's comments in the last 24 hours with the statement minutes being released, we're still looking at a 5% terminal rate. So rates look like this: hike, 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 hold, 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 cut somewhere at the back of 2023. Never forget, this is a very powerful tool for other markets as well. You know something others don't. That's amazing. And I'll be sharing with you guys an indicator over the next week that a lot of people don't have, and I think you'll really enjoy it. So make sure to subscribe and smash that like button if you enjoy this type of stuff. Let's talk about copper. Yeah, copper is okay. It's moving down and then it's moving back up. If copper continues to weaken, just remember, copper is a great signal for economic health. We've seen copper dive throughout 2022. We've seen a bit of a recovery. If it starts diving, especially if it makes new lows, you have to be paying attention to that. What that's telling us is that we're going to need the Fed to cut. We're going to need the support of interest rates being cut because there is a sickness in the economy. Copper is one of the most used metals in any kind of build really throughout the world, infrastructure, and likewise, it shows us government, realistic projects, all sorts of things go on. So Dr. Copper is finding some support for now, but as we go and we drive down into the 2 hours, you'll notice that, yeah, this level is key, but it's not necessarily super just yet. I'm going to set a little alert underneath just in case that happens. If it does and the stock market's driving higher, well, I'll take that into consideration. Another notch in the potential bear trap, or bull trap in this case, that could be set. What about the dollar index? Well, I'll actually just load up a different DXY. So we've got that. These are the forward contracts here. And you can see that the DXY came down heavily. Now, admittedly, I will say in this area, I expected a reaction. 106.25, 106.10. I expected that the dollar would probably find some buyers. It hasn't done so yet. And you can see at the time of this recording, it's driving lower. It really needs to turn relatively soon. You'll notice it got through the 61.8. This push was certainly positive for it. It found some scrappy kind of supply here. It sold off as we expected. But these two levels, we were looking for a reaction, specifically this one. And while it's driven down, it hasn't turned. I'll show you guys, though, where I'm setting alerts for this, because, of course, if it does turn, I want to be part of that type of action. So we'll actually use just the DXY code here. I do use either or. The dollar index futures will give you a bit of volume, though. And what you'll notice is that we have two really key levels. So the first one is 106.20. I'm going to set an alert for that. I'm going to set another alert for 106, basically 50. I want to see this happen. If this happens, it's a great sign that yes, buyers are coming in and recommitting. At the time of this recording, there's no reason for us, unfortunately, yet to say DXY is going up. It's just like getting plowed through the last realistically 24 hours. And since the FOMC statement came out, yeah, the meeting minutes, it's been very, very heavily hit. We do have a lot of demand down here. DXY is currently not really longable. If you're short, it's probably an interesting area here and certainly a very interesting level for targets down around 105.40. But this is still a critical area. We're going to set alerts because if we see those levels getting hit, we can start to say, okay, we see what's happening here. Now, is the euro doing something very similar? Yes, it's driving higher. And we did have, of course, this level of supply, potentially a turnaround in here. It didn't really eventuate. Again, the market came up, it made a high, it made a low, it made a higher high, it hit the same level, and then just bounced. It didn't make a lower low. It didn't really sequence activate the way we'd wish to. I'm still looking at the possibility here for euro shorts, but I will tell you that 70% of retail traders currently are trying to short this. So it's going to be a tough one. And I think you'll need to really put on the hazard lights and make sure that you're paying attention. Even if it does stop here, make sure that you're activating it with a replicable concept. Patience, react, don't predict. At this point, this thing is on a rocket ship. And this is what's happened post CPI. In fact, the last week and a half have been difficult for some traders to navigate. And the main reason is because that was a huge bit of news. It's changed the fundamental understanding of what people are trying to do underneath the market, and that means the orders have shifted, and that's a very important point. Gold's looking pretty good again. It didn't quite get down to some of the alerts that I had set down here, but we made the lower low, we've breached above, and you've got to think that now if selling does occur, gold should look pretty strong. This is a very strong bull wick demand, and as you know, boom, 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 it's come back through, it's breached this area, so pullback should be met by buy demand, and that's pushing through in gold. We do have a pretty nice bullish medium-term idea on gold here. I don't think it's necessarily over, and I wouldn't be surprised at all if Wall Street and other big players are starting to build a fairly big gold position. I'll have more on that on the weekend video that we push out. US oil has dropped, demand destruction still underway. I'm still overall negative. Of course, my target's always been around 65 and 75 for oil. First one technically has been reached, but I like what we saw recently, although it did sell off in here. I would have preferred it just did this. This is the area now that we look for potential bull moves on the shorter time frames. Let's have a look now at oil. Do we have enough structure? Probably not just yet. We're just pulling back down. Let's take a look here. Yeah, we've seen some signs of potential recovery. So we've basically got a little bit of a high. I mean, you probably need to get through 79.50 again, but it hit the level that we talked about, that 78.77. In here, we expected some buyers to potentially recommit. So far, they have. It's not a great trade. I probably think it's like a 6 out of 10 kind of position, but certainly it's in the right zone, and it is finding some buy demand, which is what we expected. Now we go to the elephant in the room, and I'm sure a lot of you are very conflicted on this one. Is Tesla recovering, or is this all part of some nasty rally? Well, the good signs are that Tesla had a pretty good day. And of course, on the weekly, if it closed like this, I said, well, we have to really think about what just happened, because the market obviously shot down. It kind of hit in this middle zone. I've said for a while, I still think it goes here. I still think that's very, very possible, especially if the market turns soon, but it had a massive rip roar. And if the Friday trade, when the markets are back open, actually holds this level, that will be significant. We cannot deny that. There are plenty of unfilled gaps that are above on Tesla that we could see still hit even in a recovery. Now, let's have a look at what actually happened here. So the markets went down, they gapped low, then they turned and they gapped higher. You would have to think that some pullbacks will be met by buy demand now. So I think that's going to be an interesting one. I'll just whip out a quick 61.8 fib, something like this. If we get back into that 172 level, this area here may be interesting. So a little alert just in case if that does happen. Now, why? Well, I think it's just extreme selling. We've talked about this 200 being broken. I've set the alert there. If this occurs, you know, I'm obviously feeling a little bit more bullish on the medium or the low term, kind of 1 month, few weeks, that kind of period. But at the moment, it's just an oversold market, probably a ton of puts being entered. Everyone now talking about it. We were bearish a little bit before all of this. And I think this is just the nature of manipulation in markets. But Tesla did look a lot better, and I would expect a little pullback to be met by hopefully some buyers now. Were semiconductors leading the race? No, SMH certainly didn't. We did see that island reversal here. Technically, it's still active towards potential shorts. That being said, semiconductors are always a tough one. Islands by themselves are never going to be everything. But yeah, it's still sitting in the middle of nowhere land, I guess. Apple certainly didn't trigger any short reasons. As we know, Apple, if it did get underneath here, that's a big tick towards negativity. At this stage, it is chalking up a massive coil in the markets. Do we see breakout? Could be interesting. Now, there were a few other stocks that we've been looking at recently in terms of plays, especially in the private community. If you're ever interested in joining that, it's a free 7-day trial and the link's down below. You can always check it out. The thing with stocks is at the moment, there are different sectors that are doing really, really well. And you have to just think about which one is doing the best, which one has the money flow in it, and then following that. That's usually the best way to do things. XLY versus XLP, this is our American consumer. XLY had a decent 24 hours, so it pumped up. It was looking decently good. Now, if we go over to LQD as well, we're still seeing strong pickups here in the bond market from corporates. I tell you, this is it's compelling to see that the LQT indicator, or at least the bonds, are finding these buys. This is corporate grade, investment grade bonds. Now, for most of 2022, that has not been where the money's at. I mean, look at this. It's been a horror show. So clearly it's not really yields because yields are sitting around. The market's getting a appetite for risk again. If it wasn't, then we wouldn't see the likes of LQD and HYG come up a little bit here. Nice breakout here for HYG. Again, it's still at lower highs than it's been previously. This is a great sign of recovery, but when we look at the S&P 500, you'll see one of the big headwinds coming up. New economy versus old economy, Dow versus US 500. It was a new economy day. That's, again, the type of thing you want to see with these recoveries. The DAX doing absolutely nothing. Boring time in the supply area. I won't focus on that as this video is already pretty long, but there's the DAX. Then we move over to the US 100. Now, this was a big deal. This was an area we expected sellers to come in. They committed somewhere in here and tried. They didn't get it underneath this 11.7 area, and they weren't able to activate shorts correctly. Now, what ended up happening was it just kept driving higher. So we're not back at the 12,000 yet, but I would expect this level to be hit with an S&P 500 level that we'll talk about in a second. So could we continue to drive higher for the NASDAQ? Absolutely. That's a fairly strong close there for the market. You can see here the way it's been doing it. It looks boring, but there's actually a lot of intricacies going on in these things. So again, this 12,000 level going to be the important one for the NASDAQ. Let's move over to the US 500. Thanksgiving come early, yeah? There was a small activation. If you noticed on Twitter, we talked about it. This 4,000 to 4,000 kind of 20 level. We thought there might be a potential short in here. There's always a chance, and I think it's important to look at both. There was basically a little high, a little higher high, and then a little breakdown. As you can see, they bought it straight away, pushed, tried to get back down underneath. If that had gone underneath again, then you'd have to think they were trying to sell it back down to the 39.40. But at this stage, it's grinding higher. We're back at this resistance. And if we break this, where do we go? Well, you're starting to talk about getting into the gap fill. Let's use the SPX to just highlight how big a zone is coming up. This is the 200 moving average on the daily, the green line here. We know that that stopped the market before. We also know the trend line's coming up that has been one of the best seller areas for the markets. And we also know that this trend line sits exactly on the gap fill. So there is an unfilled gap from the previous CPI number that sits here, and there's probably some resting orders there. So the market is driving potentially higher here into these 41.10s. Now notice where the actual real market closed. It closed at 40.27. So while the futures is out running away with 40.30 and stuff, it barely made a higher high, just did it. Now this is a critical point here. So if we end up driving higher, I think we push. We probably look towards that 41.10, 4100 level, and then we find out truly who wants to win this race. Is it going to be those bulls or those bears? Let's look at it on the futures market just to understand better what's going on. Here we have a whole bunch of information, but realistically, we've got an unfilled gap, we've got previous wick, we've got the downward trend line, and we've got a whole bunch of confluence at this zone. So yeah, if we keep driving higher, guys, which it looks like we could, this will be the big area. And of course, with the VIX at basically 20 or under, it all lines up with the previous periods. Will it work? Of course, we'll find out whether we get an activation around that time. But if we do get an activation, of course, we'll be talking about it on this channel. That'll be a big point. And it's all getting exciting because we're getting very close to that area. For the week ahead, for, of course, options, this is not a big options week, so we don't tend to focus on it too much. Let's go to the 25th expiration. 1.2 million options, and they're all sitting at the same strikes. 410, 400, 390. That's where they are right now. So 410, of course, we would drive up. That would be okay for them. Max Payne's at 394, so to hover around here would be not too bad for the market. And again, very profitable for them because both ends here, as long as they expire at somewhere in this middling zone, they make very good money. Remember, who writes the options? Generally Wall Street, the composite man, the big players. It's not us, the small retail traders. It's some of us, but most of us don't write the options. Let's have a look here at, of course, Bitcoin. This is the elephant in the room in terms of, is there a sickness here that's worse? Here we have the average kind of pullback periods. Actually, it's about 420 days here, 86, 84, and we're probably sitting about 78, 79 on the lows at this point. So is Bitcoin improving? Well, it has improved. So we talked about the idea that Bitcoin breaking here should drive into this area. This was the turning point that pushed us to the new lows. So if sellers are going to come back in, they should commit somewhere right around where the price is right now. So we'll put a little alert just underneath this 16,300 level. And if that is taken and we move forward from there like this, I think that the market will actually drive lower with Bitcoin. It could be a precursor for stocks it's worthwhile paying attention to. 17,000 will also be an interesting high. And if we break past 17.2, you've got to think pullbacks being met by buy demand, at least in the short term. Very interesting point and super impressive stuff. So of course, we're going into Thanksgiving, and I want to give a big shout out to every one of you in the community out there. I hope you're having a good time with your family. You have a great catch up with everybody. And of course, everyone else around the world, I'm sure we all have a lot to be thankful for. So for the FX Evolution community out there, I wanted to say a happy Thanksgiving, and of course, enjoy time with your family, friends, and everybody else. Do we have a bank holiday? Yes. Does that mean reduced liquidity? Absolutely. And as we enter into the Friday, we know that that can be also a bit of a thin trading day with all sorts of shenanigans going on. In general, the cheer seems to be here. Hopefully it can hold up. And next week, we move into a new week of economic data, which we'll talk about on the channel as we bring that out. So yeah, that brings us to the end of today's video. It was a long one, but I hope you did get some value in it. There's a whole bunch of conflicting ideas. We're getting to the precipice of an inflection point. Remember to subscribe and smash that like button if you're interested in joining us along this journey of the next couple of weeks. And as always, I want to say a big thank you to each and every one of you for being awesome, and have a great long weekend for people in America. Bye for now.